What's good, everyone? My name is Chase Lawson. This is the Financial Freedom Show where I make personal finance simple. Thanks for tuning in. So today kicks off a three-part series on investing in the stock market, where I'll go into depth into what exactly the stock market is, how to read stocks, what the different types of investments you can make are, as well as some of my top recommendations when it comes to stocks for you to invest in. So today is part one, where I cover the stock market from a macro level. To stay updated on parts 2 and 3, make sure you hit that subscribe button as well as the notification bell below. Enjoy!
For those who don't know me, my name is Chase Lawson, and I'm the author of Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth. Today I wanted to talk about the stock market. I'm sure a lot of you listening probably have heard the term stocks and the market, and a lot of people do like to hype up investing in the market, but many of you may not even know where to begin. So this video is for you. This is a crash course into investing, how to do it, what some of the different terms are, and more. I'll even leave you with some of the investments that would be great for you to go ahead and get started in. So I'll leave some recommendations for you here at the end as well. Now, just to clear up any misconceptions, you do not need to be rich to be able to invest in the stock market and follow the lessons that I will be sharing. Whether you have $10 or $10 million, you are capable of investing. Many people put off investing simply because they find it to be confusing and they don't know where to start. Investing does not have to be confusing, and when you break it down, it's really easy. So my goal here today is to get you comfortable with the stock market and investing and help you make a lot of money. Now, there are a lot of more advanced strategies and tips and terms, things like puts and calls and trading on margin and more that, some more advanced investors may utilize, but you don't need to worry about any of those terms. Most people don't even do that. Even the mega rich don't even always follow that. So these lessons today, most people who do invest follow these, and it'll get you where you need to be. As you become more comfortable, you can learn some of these more advanced strategies, but follow the tips in this video and that'll get you where you need to be and still allow you to make a lot of money. So with that being said, first off, what even is the stock market? So in a nutshell, the stock market is where investors can buy and sell securities or investments like stocks, bonds, mutual funds, exchange traded funds, and cash equivalents like treasury securities. So what the stock market is it's essentially a safe and regulated auction house where buyers and sellers negotiate prices and trade investments. It's a network of exchanges, and companies can list shares on an exchange for investors to then buy and sell. Now, I'm sure a lot of you probably have seen in movies and TV shows, big trade floors with people screaming and yelling trades in. That's not really how it works today. These days pretty much everything's done online digitally, not in person. So, you can do it right from the comforts of your home. Now I did just talk about the term exchanges. So what is a stock exchange? So a stock exchange is where company shares are traded. So you probably heard of some of these, but the top 5 stock markets in the world and exchanges are the New York Stock Exchange, NASDAQ, Tokyo Stock Exchange, Shanghai Stock Exchange, and the Hong Kong Stock Exchange. So when a company lists its shares for sale in the market, they get listed on one of these exchanges. And that's where things are bought and sold. In addition, the stock market also creates and maintains what are called indexes. So an index essentially indicates the performance of the stock market. There's various indexes out there, some of which you've probably heard of before. But each index has a collection of various securities that they hold and invest in. So some of the major ones in the U.S. that I'm sure you guys have probably heard of are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. And so each of these have various different holdings, like I mentioned, and serve different purposes. But these are generally viewed as pretty good indicators of how the market is doing, and people will reference these when they talk about the market. And when one of these indexes drops, it means that the average value of all the stocks that it holds in the index has dropped from the previous day. And then conversely, obviously, when it rises, that means that the average value of all the stocks it holds have gone up from the previous day. Now, as I mentioned, these three indexes serve different purposes and have a different number of stocks listed covering different industries and company sizes as well. And all of them use a weighting formula to get to the ultimate price. And that weighting formula varies slightly between the three. But first and foremost, the Dow Jones is one of the most exclusive of the indexes. So the Dow only includes 30 stocks. So all 30 of these stocks are among the largest, richest, and most heavily traded companies in the U.S. It includes companies from all major sectors in the market outside of utilities and transportation. And so as a result, while a lot of people will view it as a good indicator of the broader market, it can be kind of more limited because obviously it's only holding 30 stocks. So, very relatively small sample size. And then these stocks that it does hold are the most sizable companies out there. So the Dow really is more of an indicator of how the large blue chip stocks are faring. And a blue chip stock is a huge company with an excellent reputation. So not necessarily the best indication of how the ultimate market is doing, but still a pretty good measure. Next, we have the NASDAQ. So the NASDAQ Composite Index includes all companies listed on the NASDAQ stock market exchange. So that's a total of more than 3,300 stocks in all. So it's a lot broader than that of the Dow, obviously 30 versus 3,300. But one downfall of NASDAQ is that it has a high concentration of technology stocks. So the composite index for the NASDAQ is a lot more sensitive to the technology sector than it is other sectors in the marketplace. So it can be more limited. Obviously, if technology is doing really well, but other industries are not doing well, NASDAQ will do relatively better than the broader market, and then vice versa. If tech industry is doing really poorly, but other industries are outperforming, then the NASDAQ will kind of trail that of the market in general. So another, you can use it as a good indication of the market, but it is more limited because it focuses mainly on the technology sector. Last but not least, and the index that a lot of people view as the best single gauge of the current condition of U.S. equity markets is what is the S&P 500. So S&P standing for Standard & Poor's, which is the company behind the S&P 500. So the S&P 500 index includes 500 companies from all sectors of the economy, with stocks either listed on the New York Stock Exchange or the NASDAQ. So combined, these companies in the S&P 500 account for about 75% of all U.S. stock. And the S&P 500 is made up of large companies like the Dow, but it is still considered a more reliable gauge because, once again, it has 500 stocks and it covers all industries. So it's a very broad indicator of how the market is performing as well. And so you'll see a lot of, funds and investments and analysts and experts, talking about the S&P 500 or tracking the S&P 500. That is largely why that is, because it's the best single gauge. Now, as I mentioned, each index weights their stocks differently. So some have more influence than others on the total value of the index. And the weighting is done on the basis of the company's share prices, the current market value, and other factors. But once again, since these do include companies from a myriad of industries, they are seen as solid indicators of how the U.S. economy is doing overall. So what ultimately affects the stock market? So there's various factors that impact how the stock market ultimately performs. That includes things like the political climate. So that's why you'll see anytime we have a presidential election, the stock market can typically be a lot more volatile as the election is nearing. If there's a change in party that gets elected, you may see stocks go wildly up or wildly down as a result. In addition, there's social factors. So, largely what's happening right now with coronavirus, it has largely impacted the stock market. Then we have things like interest rates. So whenever the Federal Reserve changes interest rates, that impacts the stock market, as well as other trends and shifts in what investors prefer. And while I touched on in a prior video that the stock market is not the economy and they don't always correlate, generally if people feel like the economy is going to be taking a turn for the worse, they'll start selling stocks, which will ultimately drive prices down. And then on the flip side, when people are feeling confident and optimistic about the market, they tend to buy stock, which raises the price. So we've been talking a lot about more macro terms like the stock market and indexes and exchanges, but let's get on a more micro level here. So what exactly even are stocks? So at the most basic level, a stock is simply a share of ownership in a company or corporation. So when you own stock, you actually own part of a company, and you are entitled to part of that company's earnings and assets. So companies do have a liability to their shareholders to ultimately maximize your return. And then within that, there's two types of stock. So there's private and there's public. So private stocks, typically the general public does not have access to them. These shares are usually more limited in number, and it's held by a small number of people, such as internal employees or investors in a company. So you cannot buy and sell these on the broader stock market. So most people, this won't apply. So we don't need to worry about private stocks. When you think about stocks, you typically think about public stocks. So public stocks are stocks that the general public can buy and trade on a stock market exchange, like the New York Stock Exchange or the NASDAQ. These are available to the general public. So what you'll see is when a company decides to go public, they'll release what's called an IPO, or initial public offering. This is a way for them to raise capital for the company. And so they'll value their shares accordingly, and then they'll list the shares at a certain price, which then investors can rush in and buy those shares and then start trading. That's kind of how things start. Public companies do have a liability, like I mentioned, to maximize the return for their shareholders as well. And they must release quarterly and annual financial statements and earnings reports and more. In addition, we have a couple types of stock as well. You have preferred stock and common stock. So preferred stock is a safer investment. With preferred stock, you receive a fixed dividend per share that a company must distribute before they pay any shareholders of the common stock. So if you're a shareholder of preferred stock, you're guaranteed that dividend for as long as you hold it. But one downside is that you rarely get voting rights in the company. So, and then in addition, with it being more secure and having that fixed dividend in place, oftentimes the return potential is a lot lower than that of common stock. So typically the riskier an asset, the better chance of larger returns you have. When people think about stocks, they're typically talking about common stock. So common stock is the most basic way to have ownership in a corporation. So every share of common stock you have gives you a proportionate stake in that company. And there's really two ways to make money when it comes to common stock. The first is through cash dividends, which we just talked about with preferred stock. So what a dividend is essentially when a company is profitable, it's them returning part of that profit to their shareholders. Now, as I mentioned before, a public company does have a liability to its shareholders to maximize their returns. That's part of a requirement of being a publicly traded organization. So that's why you'll see companies pay out those part of its income to their shareholders. Not every company pays a dividend, but a lot do. So that's one way to make money there. And you can either take that in cash or reinvest that by buying additional shares in that company. The other way to make money with common stock is through price appreciation. So stocks get traded every day. The market's open and prices will go up and down. But when the price does go up from what you bought it at, that provides you additional income off of that. In addition, owning common stock usually gives you voting rights within a company. You can vote on matters like who's elected to the board of directors, any potential mergers or acquisitions, as well as any other number of company policies or things up for vote. And however many votes you get is depending upon how many shares you own. So you'll typically get something in the mail, or via email, kind of letting you know about the annual shareholder meeting coming up, and you can either attend that in person or you can vote by proxy, which is essentially, filling out your preferences for how you want to vote, and somebody who is in attendance at the annual meeting will vote on your behalf according to your wishes. So that's pretty cool. If you own stock, you get a say in how the company proceeds on matters like that. In addition, pretty much every time the CEO and other C-level executives likely own a large number of shares in that company as well, whether it's through them just buying it outright or part of their compensation package. So that's another reason why they like to pay out things like dividends, because it ultimately provides additional income for those higher up employees at the company as well. So now that we know what stocks are, why do they ultimately go up and down? So there's a number of factors. I know we talked about it before, such as the political climate, social factors, interest rates, and more. Those are external factors. But in addition, there's a number of internal factors that impact a particular company's shares. But ultimately, when it comes to stocks, it's all based on the law of supply and demand. So when there's a high demand for a particular stock and few people selling, the price goes up. And conversely, when there's a low demand and a lot of people selling, the price goes down. So what ultimately determines that demand is based on the company's performance and earnings. As I mentioned before, companies will release quarterly and annual earnings reports, and analysts will project how well a company will perform, as will the company. And if the company outperforms their projections, typically you'll see the price rise, and if they underperform, typically you'll see the price drop. So that plays a major role. In addition, it's partly due to speculation. If investors feel pretty good about a particular company, the shares will go up. And if they're not feeling too good about a company, the shares they'll start selling, which will drive the price down.
Thanks for watching part 1 of the 3-part series on investing in the stock market. I hope you enjoyed. Part 2 will cover how to read stocks, so make sure you subscribe and hit that notification bell below so you can stay updated when it comes out. If you enjoyed this video, be sure to give it a thumbs up and leave me a comment and let me know what other questions you have about the stock market. Thanks guys, and go get them.